Good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Wednesday, June 2nd, 2021. And here are our top stories. Small business owners turn to personal credit during the pandemic. Well, joining me now to discuss this and a lot more is Andrew Howitt. He is Senior Vice President at the Federal Reserve Bank of New York. Andrew, so great to see you. Thanks so much for joining us on the program this morning.
Thanks so much for having me, Jeffrey. Glad to be here.
Yeah, and look, small business, that is the lifeblood of the American economy. And you and the team over at the Federal Reserve Bank of New York just did a stunningly great analysis, I should say, of small business and how it was impacted by the pandemic. Let's start with the macro. Why don't you give us your take, you and the team's take at the Federal Reserve Bank of New York around the impact of the pandemic to small business owners around the U.S.?
Yeah, thanks. Well, I think it's fair to say that like lots of other businesses and lots of other households, small business owners have been hit extremely hard by the pandemic. It hasn't been even across the board. There have been some variations, and I hope we get a chance to talk about those. But the sort of overall reductions in economic activity, especially at the very beginning of the pandemic, at the outset, about a year ago now, especially the reductions in consumption and particular kinds of retail sales have really been especially difficult for small business owners, in large degree because they may have smaller financial cushions to fall back on than, say, a big business. So it can be an especial hardship for small businesses. And then, we see some of that being reflected in their personal finances, the finances of the small business owners themselves.
Yeah, and you bring up the personal finances, and look, I think of it, this is just my anecdotal, no evidence other than anecdotal evidence. I think small business owners hit disproportionately versus larger businesses for obvious reasons, more access to capital. Some of the small business owners took the Paycheck Protection Program loan, the EIDL loan from the Small Business Administration that the federal government set forth in its policies during the pandemic. But you made mention of this. Let's talk about the disruption to personal finances. How do you and the team kind of see that? How have personal finances for many of these business owners been disrupted?
Yeah, so I should say that we use data on the credit reports of a large sample of households in the U.S. It's anonymized, so we don't have any idea who the individuals are, but we can tell a few things about them. And one of the things that we can tell is whether or not they own a small business. We can see if they match up with a small business registry. And so when we look at that, we can see that small business owners were much more likely than we might have expected to take advantage of particular kinds of programs. And the one that we focused on in the work that you're referring to is mortgage forbearance. So at the outset of the pandemic, Congress passed a law, the CARES Act, which either required or strongly encouraged people who are lenders, mortgage lenders, and the agencies that sort of back those mortgages in the federal government to offer forbearances to households that have had some hardship because of the pandemic. And by forbearance, what I mean is the opportunity to sort of delay or reduce your mortgage payment for a time while the hardship is still going on. And of course, as we mentioned before, the pandemic was a very widespread hardship for many, many households, and millions of borrowers took up this offer of mortgage forbearance. It was especially borrowers who you might have guessed, people who were maybe a little bit hanging on by a thread before the pandemic, had a little bit more of a challenging financial situation prior to the pandemic. But we also found that a lot of small business owners took up mortgage forbearance. In fact, they took up mortgage forbearance in much higher numbers than we might have anticipated. Why do I say that? Well, these borrowers are actually not just barely hanging on. They're not, sort of previously delinquent on their mortgages. In fact, small business owners, compared to the general population, have higher credit scores. They live in wealthier neighborhoods. They're less likely to have delinquencies on their credit reports, and they're a little bit older. So for all these reasons, you might have expected to see that they would take up mortgage forbearance, this offer the ability to miss some payments at pretty low rates. In fact, if you look at relatively wealthy neighborhoods, people took up mortgage forbearance at pretty low rates in wealthy neighborhoods, but not small business owners. Small business owners actually took up mortgage forbearance at pretty high rates.
Yeah, and Andrew, when you look at you kind of slice the data by industry, are there particular industries that maybe have been hit harder than others? I'm just thinking, again, having read your blog post or your article, you and the team's article, I think restaurants and places that people go to congregate, we clearly couldn't do that. But are there industries that you picked up on that were really negatively impacted?
Yeah, I think you put your finger on it. It's mostly the sort of really high rates seem to be associated with industries that we kind of know were especially hard hit. This gives us some comfort, by the way, that we're finding the right things in the data. The industries that are especially hard hit. So, for example, restaurants or entertainment venues, travel kinds of venues. These we know were especially hard hit. I guess putting it a little more generally, and then now I'm relying on work from some of my colleagues, other than the team that wrote the report you're talking about. We know that businesses that depended on discretionary expenditures more than sort of necessity type expenditures were the ones that got the most hard hit. So we know that like grocery stores, manufacturers, companies that produce goods held up relatively well compared to service industries. Some of that's because, of course, everybody needs to eat regardless of the status of the pandemic, but also because if people were able to get goods delivered to the house much more easily than services. And so goods producing industries held up a little bit better than service producing industries. Now that's true across the board, but it's also true to at least a large degree for small businesses in particular.
Andrew, when you think about, and I want to get to the reopening phase in our second segment, last question for this segment, what is the impact when you think about people getting forbearance, doing that today, small business owners getting forbearance, maybe they're opening up a home equity line of credit, a home equity line of credit. Are there things that you'd be looking for down the line when you look at the data again, maybe in 12 months or whatever the plan is, 12, 18 months, 24 months down, you're kind of trying to track some level of progress or lack of progress? Are there things that you're looking out for?
Yeah, and I'm glad you brought up home equity lines of credit, because I'd like to say a little bit about those as well.
Sure.
So I mentioned these mortgage forbearances, and they're an important indicator that we see of the distress that small business owners were in, to some degree at least, and also the ability and the flexibility that they took advantage of to be able to fund their businesses. So we infer from the data on mortgage forbearances that small business owners were sort of taking advantage of their personal credit to help keep themselves afloat, maintain their cash flow during the pandemic. And we see a little bit of evidence of that from home equity lines of credit as well. So what we see there is that it's not so much that we see new lines of credit being opened during the pandemic by small business owners, but we do see them drawing down their home equity lines of credit. So as you probably know, home equity lines have a limit. There's an amount that you're allowed to borrow against your home. That's sort of a maximum. And people may borrow less than that or up to that maximum. What we saw during the pandemic was that small business owners who had available credit on their home equity lines actually drew that credit, especially in the early months, in the spring and summer of last year. Now, that may not sound surprising or unusual, and you might expect that we would see that in a lot of kinds of households, but actually we don't see that in a lot of kinds of households. In fact, the trend in these home equity lines across households in general for the last 10 years or more has been for the balances to be falling. So it's pretty unusual to see a group of borrowers increasing their HELOC balances at any point in time. And we think it's especially telling that we observed that during the early months of the pandemic. Now, I should note, and this is getting to the second part of your question, starting in about the fall of last year, we see pay down resuming among small business owners. Pay down continued among non-business owners throughout the pandemic. We see increase in balances and then a resumption of declines in balances among business owners starting in the fall. That continued until March, when we got our last piece of data, March of this year. What I want to say, though, is that these small business owners still haven't caught up to where they would have been had they been more like the general public. And that's the kind of indicator that we want to see as sort of some evidence of healing here. So going forward, we'd expect to see that they would continue to pay off like the rest of the population. A sudden spike upward in the borrowing on these home equity lines would make us start to wonder if the cash flow problems of last spring and summer are reappearing. And that would obviously be a warning sign for the sector going forward.
Yeah. Well, Andrew, I need to take a quick break. And when we come back, we'll talk more about the impact of the pandemic on small business owners, their personal finances, and also the path ahead during reopening. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. We're talking to Andrew Howitt of the Federal Reserve Bank of New York. Andrew, thanks for staying with us this morning.
I'm enjoying it. Thanks for having me.
Yeah, this is a great analysis, and you all did a tremendous amount of work pulling this information in. As we said that, throughout our conversation, the American small business is a really important part of our economy. Let's talk about reopening. What are things that you talked about, some of the leading indicators, things that you're generally looking at, but when it comes to reopening in different parts of this country, maybe by sector, by industry, what are some of the key things that you're looking at as a team to track and measure either, success or less success or more success?
Yeah, so that's a great question, and of course, we're always thinking about what's coming next and what's going to happen in the future, and how to provide information that'll be useful to the public and policymakers in monitoring what's happening and what's going to happen. So maybe I'll take a fairly broad approach to that question, and then we can zero in on any of the parts that you'd like to talk about in more detail. So of course, a major factor is going to be how the pandemic proceeds, and of course, we think that things are improving quite substantially now, but maintaining that trend and that improvement will be very important, and that's important because the strength of the overall economy, as we've seen over the last year, is going to be highly correlated with the pandemic and with our success in combating the pandemic. So that's number one. How is the overall economy going to do, and that's going to depend on the pandemic. So in particular, within that, one of the things that's very important for small business owners is going to be consumer spending, and so how consumption changes over time is going to be something that we're going to keep a close eye on. We have a variety of ways of doing that. One of the things that we like to look at is use of credit cards, and so we've seen some ups and downs in credit cards over the last year that are consistent with a sort of unusual pattern in the macro data. The unusual pattern has been that just as consumption collapsed in the spring of 2020, pay down of credit card balances went up. So people stopped buying so much stuff and they paid down their credit card balances at the same time. Incomes were rising sharply because of the original round of stimulus payments. So the data are sort of going in different directions. It's a little bit hard to disentangle. At the beginning of this year, we saw a very large increase in incomes again from the second and third rounds of stimulus payments, and an increase in consumption. But nonetheless, we saw credit card balances going down. So what do we infer? We infer that the households in the economy are taking advantage of these stimulus payments to pay down their most expensive kinds of debt. So what does it imply for the future? In the future, we're going to be very closely monitoring the relationship between consumption and income and savings, and how that plays out in terms of borrowing and repaying of debt. And what's that going to tell us? Well, one of the things it's going to tell us and give us some indication of is how the large amount of savings that's out there in the economy is going to get deployed. Are people going to take a trip? Is everybody going to fly to Hawaii as soon as they can, start eating 3 meals a day in restaurants? Or are they going to go back to their normal habits, their prior habits, and keep that cushion of savings around, or something in between? So that will have a big influence on how the economy evolves, whether we get a really hot economy in the fall or whether it's sort of back to normal. And that'll, of course, have big implications for small business owners. So those kinds of things are, I think, really important, sort of what we think of as maybe real indicators, what's going on in the hard nuts and bolts of the economy. And then there's some financial indicators as well that we will, and my team, and by the way, I want to give my team tremendous amount of credit for the hard work that went into the blog series that you're referring to, and I'm really glad that you have found it useful. It's a great team. But in the credit data, what we hope to see is people able to transition out of these forbearances safely without finding themselves falling behind on the mortgage. So we know a lot of people have taken advantage of mortgage forbearance over the last year. And we're hoping that as the forbearance programs end, these families and households will be able to resume making their monthly payments without falling into delinquency. And so, of course, that'll be something we're really closely monitoring, especially maybe small business owners who might be asked to start making their mortgage payments before their businesses are fully recovered. And so that timing might not work out exactly right. And so we'll be especially watchful on how their credit portfolios, their debts perform as forbearances end.
Well, you bring up some really interesting points, and as you were talking, I was thinking about all the pent up demand. My wife and I, as I mentioned to you off in the green room, we just moved to Charlotte. We really haven't gotten out much. I think a lot of people probably want to get out there, but as a saver and someone who has a television network or works on the television network that is around saving and saving not only for today but also for tomorrow, I wonder what your thoughts might be around, balancing that. It's always a balancing act, right? Consumption today versus consumption tomorrow, and just thinking about things like retirement. We're living longer in retirement. The biggest expense in retirement is healthcare. I just wonder how you kind of factor that into your thinking as a group, as a team at the bank.
Yeah, I mean, these are super important questions, and I think this experience over the last year has been really unprecedented, as I'm sure you're well aware. The savings rate hit 33% in last spring and has been elevated for most of the year as these stimulus payments have come, but consumption opportunities have been very limited. It wasn't possible really to fly to Hawaii even once, let alone more than once. And so, how this evolves, how those savings get deployed are important in the short run, because if they all come into the economy at once, that'll have implications for prices and, how much growth we see in the short run. But also, even maybe more importantly, as you say, how they get used in the longer run, and how families and households are able to be prepared for their future. I don't have a crystal ball. It's hard to know how those things are going to play out, but I can say that we will certainly be watching very carefully the indicators that we have access to make sure that we're keeping up to date on what's happening as it's happening.
Yeah. Well, Andrew, very interesting study. Great work by you and the team. I want to thank you so much for joining us on the program this morning. And as you get more research, we'd love to have you back on. So please join us sometime in the future.
Well, great. Thanks very much, Jeffrey. I really enjoyed talking to you, and I'm glad you benefited from the work.
And that wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to, then drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more, check out today's edition of our daily newsletter, The Morning Pulse. We're back again tomorrow for another educational, exciting, and entertaining edition of BRN AM. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited, and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.